Tensions in the Middle East and a deepening chip stock sell-off are reshaping global markets. Meanwhile, the Federal Reserve is caught in a heated debate over interest rates. Here are today's top 10 stories you need to know. As we look forward, the economic outlook is becoming increasingly complex amidst rising uncertainties. Recent geopolitical tensions, particularly in Eastern Europe and Asia, have heightened concerns among investors. Additionally, potential changes in Federal Reserve monetary policy, including interest rate adjustments, are influencing market sentiment. This volatility has led to fluctuating stock prices and altered consumer confidence levels. The interplay between economic indicators, such as inflation rates and employment figures, and these geopolitical events will be pivotal in determining investment strategies. As businesses and consumers adapt to this shifting landscape, proactive measures will be essential. Looking ahead, analysts suggest that sectors like technology and renewable energy may present opportunities, while traditional industries could face challenges. Investors must remain agile and informed to navigate these complexities successfully. As the market grapples with several challenges, regional banks have demonstrated resilience in their financial performance. Reporting strong second-quarter earnings, these institutions have highlighted stable consumer spending and an uptick in loan balances. This positive news comes at a time when broader market uncertainties are prevalent, particularly due to geopolitical tensions. The performance of regional banks suggests that consumer health remains robust, which could be a key factor in sustaining economic growth. Analysts note that this resilience may contribute to a more favorable outlook for the broader banking sector, signaling potential opportunities for investment as the market navigates through turbulent times. As regional banks continue to report strong earnings, their influence on the overall financial landscape is becoming increasingly significant. Recent geopolitical unrest has prompted significant market reactions as investors process the implications of escalating tensions in the Middle East. This ongoing conflict has created a ripple effect, leading to increased oil prices and heightened concerns about supply chain disruptions. Historically, such geopolitical instability has resulted in market volatility, drawing parallels to previous conflicts that spurred investor caution. Analysts note that these tensions not only affect immediate asset prices, but also influence long-term investment strategies, as sectors like energy and defense often see increased interest. Additionally, central banks may adjust monetary policies in response to economic fallout, further complicating market dynamics. As the situation evolves, investors are urged to remain vigilant and adaptable, considering both risks and opportunities. The potential for extended unrest could lead to further shifts in market sentiment, making it crucial for stakeholders to closely monitor geopolitical developments and their implications for global financial stability. South Korean semiconductor giant SK Hynix has officially debuted on the Nasdaq, marking the second-largest U.S. share sale in history. This significant milestone occurs amidst a turbulent landscape for the semiconductor sector, which has been grappling with heightened volatility following recent sell-offs among major chip stocks like NVIDIA and AMD. The initial public offering, IPO, not only underscores SK Hynix's ambition to expand its footprint in the U.S. market, but also reflects the ongoing reassessment of demand for AI chips, a critical area of growth for the industry. Investors are closely monitoring how SK Hynix's entry will reshape competitive dynamics and influence investor sentiment within the semiconductor landscape. The performance of this IPO could set the tone for future tech investments, especially in the AI sector, which is poised for rapid growth. As market participants analyze SK Hynix's impact, the outlook remains cautiously optimistic, with analysts predicting that the company's success could invigorate investor confidence in semiconductor stocks. Investors are poised for a pivotal week ahead as Alphabet and Intel prepare to report their second-quarter earnings. These results are anticipated to play a crucial role in determining the future direction of the AI trade. With high profit expectations set for both companies, the stakes are particularly high. Should either company fail to meet these expectations, it could trigger a significant downturn in the tech sector, with predictions of a potential 5 to 8% drop. Conversely, a strong performance could restore confidence in the AI-driven rally that has characterized recent market trends. Both stocks are currently testing critical support levels, and their earnings reports will serve as a critical catalyst for the tech sector's momentum in the coming weeks. As investors await these results, the broader market sentiment hangs in the balance, underscoring the interconnectedness of technology performance and economic outlook. Despite the prevailing market uncertainties, Wall Street's largest banks have reported a reassuring tone regarding the health of the U.S. consumer. Major financial institutions have cited steady consumer spending, rising loan balances, and robust credit quality as indicators of resilience in the face of economic challenges. Regional banks, such as U.S. Bancorp and PNC Financial, have reported broad gains in their second quarter earnings, driven by a rebound in lending activity and strong fee income from various services. This positive performance alleviates concerns that geopolitical tensions in the Middle East would adversely affect loan demand and consumer confidence. Moreover, banks in India, including ICICI Bank and HDFC Bank, have reported impressive profit jumps ranging from 5 to 27% year over year, showcasing a global banking resilience that extends beyond U.S. borders. The strong earnings reported by these banks may support a broadening of market leadership, benefiting both cyclical and technology sectors. As banks navigate through turbulent economic waters, analysts anticipate a continued strengthening of lending practices and consumer trust in the coming months. Netflix has faced a significant setback following the release of its second quarter earnings, which were disappointing and accompanied by a weak forward forecast. The company reported revenue and subscriber growth figures that fell short of analyst expectations, raising alarms about its future growth trajectory. Analysts noted that Netflix's management warned of slowing returns on investment for content and increasing subscriber churn, factors that have added pressure to the media and streaming sector. This downturn comes amid intensifying competition from rivals like Disney Plus and Amazon Prime Video, which have aggressively invested in original programming. Following this disappointing report, Netflix's stock tumbled, breaking below its 200-day moving average, a classic bearish signal. Analysts are now eyeing the next support level at around $520. The decline in Netflix's share price has implications beyond the company itself, reinforcing broader concerns about the overvaluation of growth stocks in the current market environment. Looking ahead, investors will closely monitor Netflix's strategic adjustments and content investments as it seeks to regain momentum in an increasingly. The Federal Reserve is currently embroiled in a heated debate over the necessity of raising interest rates to combat persistent inflation. Cleveland Fed President Beth Hammack has joined a growing faction within the Fed, advocating for a potential rate hike to stabilize rising prices. This comes as inflation remains above the Fed's target, straining household budgets and eroding purchasing power. Meanwhile, Chairman Kevin Warsh emphasized his commitment to lowering inflation, but left the path forward vague, creating uncertainty regarding future monetary policy direction. Interestingly, New York Fed President John Williams expressed a contrasting view, stating he sees no immediate need for rate adjustments, highlighting the internal divergence within the Fed. This reflects the complexities of the current economic landscape, where inflationary pressures coexist with signs of economic slowdown. Money market funds are reacting cautiously, adopting a more conservative portfolio strategy amid this uncertainty. Analysts suggest that if inflation continues to prove stubborn, the Fed may opt for a rate increase of 25 to 50 basis points in upcoming meetings. Such a move could lead to a spike in bond yields and a pullback in equity markets, complicating the financial outlook for consumers and investors alike. The semiconductor sector is experiencing its steepest weekly decline in over a year, as U.S. stock index futures plummeted on Friday. Major chip manufacturers, including NVIDIA, Intel, and AMD, have fallen below crucial 50-day and 200-day moving averages, indicating a potential shift from a bullish to a bearish market trend. This sell-off comes amid growing investor anxiety as the Nasdaq composite indexes face mounting pressure, with the relative strength index sinking into oversold territory. This downturn raises significant concerns about the sustainability of the AI-driven rally that has propelled the market in recent months. The semiconductor industry is vital for tech innovation, and any slowdown could ripple through various sectors reliant on AI advancements. With Alphabet and Intel poised to report earnings next week, the stakes are particularly high. Analysts suggest that a failure to meet elevated profit expectations could precipitate a notable correction in the tech sector, potentially resulting in a 5 to 10% decline. The outcomes of these earnings reports will be pivotal in determining whether the AI boom can rebound or if it will encounter a steep downturn in the weeks ahead, shaping the future landscape of technology investments. In a significant escalation of geopolitical tensions, Iranian forces launched coordinated attacks on multiple targets in the Middle East, including a notable strike on Kuwait's international airport. This aggressive military action has sent shockwaves through global markets, particularly impacting oil prices, which are highly sensitive to geopolitical instability. Following the attacks, the price of West Texas Intermediate crude oil surged to nearly $79 per barrel, a substantial increase from recent lows around $68. This spike in oil prices is compounded by President Trump's announcement of a blockade on Iranian shipping, which raises serious concerns about supply disruptions in an already volatile market. As a direct consequence, bond yields have also risen, with 10-year Treasury yields increasing by approximately 5 basis points across the curve, reflecting investor anxiety over inflationary pressures. The implications of these geopolitical developments are profound. Analysts warn that the conflict could either bolster AI-driven growth or ignite an inflation-induced market crash, depending on how long tensions persist. As the situation develops, investors are closely monitoring oil's performance against the key $80 resistance level. A breakout above this threshold could signal further bullish momentum, potentially pushing prices toward 85 or even 90. The ongoing conflict highlights the fragility of global markets and their intricate connections to geopolitical events, with significant implications for future economic stability. Thank you for watching. Which story shocked you the most? Don't forget to like and subscribe for more updates.